Aditya Birla Sun Life Mutual Fund and MoneyMile present your goals, dreams and plans.
Hello and welcome to your GDP, which is your goal, dream, plan. It's a series where we seek to educate our viewers on what your goals are, what your dreams are, and what you can do to plan accordingly to achieve those goals. Joining me today is well-known personal finance trainer and author, Amit Trivedi. Thank you very much, Amit. A pleasure talking to you. We've seen a very difficult 1 year, but if I were to put it in context of the stock market, we saw in 2020 a very sharp fall in March, and then we've seen a significant increase after that. But, we saw a lot of fear in 2020 March. We saw people exiting, selling, and now, suddenly they feel that, we missed out on the big rally and, 100% higher numbers, they want to enter back again. What does this tell you, since you study investor behavior so closely? What does this tell you about the way investors behaved in the last 1 year?
It's a pleasure to talk to you always, sir. And as you rightly mentioned, the last year was extremely volatile. It was to such an extent that probably for the first time in the history of Indian markets, that after seeing a more than 35% fall during the year ended on a positive note. So index on 31st December was higher than index on 1st January 2020, which has not happened earlier. So from that point of view, it was very unique. Number two, the speed at which the recovery happened was also not expected by a lot of people. And just to put some trivia into it, which is very difficult to understand, 25th March 2020, all India, we had roughly 600 total live cases. And the Sensex went down to 25,000 points. By end of the year, it had almost doubled, and we were close to 1 crore cases. So while the number of cases went up, there was a hope of the vaccine, and a lot of incentives, packages, all given by various governments. So to that extent, we saw a very turbulent year. Now, this is where the investor behavior comes in. Now, first of all, people who exited out of equity markets in March, I would like to divide them into two categories. One who actually had a genuine need or a genuine concern about a drop in income or loss of job. Now, that's need-based. But there was another category of people who exited simply out of fear. It is those people who exited out of fear, and when they came back later, they had missed out on the upside, which actually highlights one very critical trait called, first, the fear of losing, and second, fear of missing out. So in the first case, the falling equity markets, there was a fear that I don't want to lose more than what I've already lost. And later on, when they saw the markets going up, now I don't want to miss out on the upside. So in both the cases, in a way, it was a fear, though the second case, a lot of people would like to call it as greed. The second bias was the hindsight bias, or the recency bias, that in the recent past markets saw a fall, so it will continue to fall. In the recent recent period, the market saw a continuous rise, so it will continue to rise. So we tend to extrapolate that recent period, forgetting that stock markets are always, and they've always been, volatile. Having said that, I would also like to add one more category of people who stayed invested, who did not exit. Now, even within that, it's important for them, in order to become better investors, they need to introspect. Why did they not exit? Was it out of their understanding of the markets, conviction, courage, patience, or simply because the recovery was so fast and the fall was so steep that they were frozen and did not act at all? I think that also is another aspect that we need to look into.
It's been a pleasure talking to you, Amit Trivedi. Thank you very much for coming by and sharing your perspective with our viewers. Thank you.
Thank you so much. Pleasure is mine.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.